Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. And on this episode, we're going to discuss choosing between an S-Corp and a C-Corp. As well, we'll take a look at the growing cost of healthcare in retirement. As well, we'll explore the question, should you borrow from your 401k? And we'll also head on over to the Plan Solutions Incorporated office bulletin board. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. Mr. Armour, how are you doing today, good sir?
I'm having a great time getting ready to go play in a charity golf tournament, so that should be fun, although it's supposed to be over 100 degrees. So, it's that time of year in Sacramento.
Yes, sir. Yes, sir. Well, as of the recording here, I turned 48 today. So,
that's right. Happy birthday.
Yeah. Wonderful to be on here with you. And I kind of challenged myself in a different way. The missus and I just did a 6-day Disney World trip. We're aficionados of theme parks, did over 60 miles of walking in 6 days in a heat wave. So I'm going to send you that energy in this heat wave for you to pull through on this golf tournament that you're in. I know you can do it, and hey, it's playing the best that you can that day and bringing it forward.
That's right. I was looking for something on YouTube last night, and it popped up the Magic Key podcast with you and Cassie. What was the headline like? When you were flying out, right? Getting ready to fly out to Disney World.
Yes, sir. Well, I appreciate you taking a look. And I know that the missus, who's a Disney fan, has watched quite a few episodes. So we appreciate your support.
Yeah, if they can't go with you, they can at least live vicariously, right?
Absolutely. One of these days, I'm going to get you there with us at the same time. I'll figure it out somehow. All right. Well, let's dive in. Choosing between an S-Corp and a C-Corp. Depends really on your tax situation, ownership goals, and long-term business planning. So let's dive into the primary difference in taxation, if we could. I think that's a great place to start.
Yeah, this is a question we've been getting lately from a number of business owners, right? As they're kind of thinking about the entity and how it relates to different things, specifically, as you mentioned, taxes being a big one, and wondering, should they be a C Corp? Should they be an S Corp? In some cases, they're already an S Corp and wondering if they should switch. In some cases, they may not have incorporated yet, right? So they're exploring the options. But usually when it comes to planning, taxation is a really big factor, as it is in other things. One of the big differences is a C Corp, kind of your more traditional corporation, is a separate taxable entity. So it pays corporate income tax on its profits. If it makes money, it's going to pay the corporate tax rates, and that money stays inside the corporation, right? So it's still held in the corporate accounts. And then if it's later distributed, such as through a dividend, then there's going to be a second layer of taxation, right? So if you think of any big companies, let's take Microsoft, right? If Microsoft makes a profit, they pay corporate income tax. If they then pay a dividend to us as investors, then we pay a lower preferential rate, but still pay taxes on those dividends. So there's two layers of taxation. Whereas an S corporation is considered a pass-through entity, which means it doesn't pay taxes, right? Instead, those profits flow directly through to the shareholders. The shareholders get a Form K-1 that they use to report that income on their personal tax returns. So they're really only being taxed once on their personal return and not being taxed at the corporate level, which can lead to, simplification and reduced taxation. But it also can lead to some other challenges, related to profits, taxes, and cash flow. So you really want to have an understanding of, what's the projection for the corporation and how taxes are going to influence that.
Yeah. What would you say are some of the biggest advantages of an S Corp?
Well, one of the things that, when the profits flow through, right? People look at, oh my gosh, I owe all these taxes on my personal tax return because of the profits of the S Corp. And sometimes they didn't receive all of those profits, right? If money is retained inside the corporation to be reinvested for growth, they might be taxed on 100,000, but they only got a $50,000 distribution.
Mm.
So that can be one of the negatives. But when it comes to losses, if you have losses in an S corporation, that can pass through to the shareholders. So if they actively participate in the corporation, they may be able to use those losses to offset income from other sources, which can be a net benefit. Now, it does get a little bit complicated in that those losses are limited to the shareholder's basis, right? So the money you contributed or the after-tax money that you have inside the corporation, you can only take losses up to that amount. And of course, if you use up those losses in a current year, it means your basis is going to be lower in a future year where you may be limited in terms of the losses. Or if you sell the corporation, you may be taxed on a larger gain because of your lower basis. So another area of planning, right? Current benefits versus future benefits and how that may play out over the long run, based on the expectations for the business. Whereas in a C Corp, the losses remain in the corporation and they basically just get carried forward to offset future income. That could be a negative in that it might not give you the big tax deduction, in the current year, which could give you tax savings and greater personal cash flow. But it could be a benefit in that those losses may be more valuable in those future years if the corporation's really, ramping up and starting to do well, and you want to be able to reduce that long-term tax liability.
Yeah, thank you. What about ownership rules? I know that they differ significantly between a C Corp and an S Corp.
Yeah, S Corp, they are more restrictive. They allow no more than 100 shareholders. Generally, they need to be U.S. citizens or residents. Most corporations, partnerships, LLCs, foreign investors, all of those are not eligible investors. So, depending on who are the owners or who may, buy in or become future owners, right? That needs to be a consideration. Whereas C corporations are very offer a lot of options. They have an unlimited number of shareholders, an unlimited number of shares that you can issue. So it can be individuals, but it could be other corporations, partnerships, trusts, foreign investors, just a lot of flexibility. And S corporations can only have one class of shares,
Mm.
right? So just one class of shares, all of the owners are basically treated equally. Whereas C corps can have multiple classes. So you can have preferred stock. You can have, sometimes A and B and even C shares. You'll see sometimes that have different rights, including some may have preferential voting rights, right? So some people, a certain class of share, they may be owners, but they don't get to vote, whereas others, do get to vote. So a lot more detailed planning can occur.
So does that allow for greater flexibility when raising capital as well?
Exactly, exactly. Yeah, S corps it's pretty simplistic in terms of the options are available, but for most small businesses, it meets their needs, right? And keeps the cost down and maybe more tax efficient. But for a C corp, especially if the idea is this is something that could grow, to really be quite large and may need to continually get access to additional capital to fund that growth, having greater flexibility in terms of types of investors, different share classes that can be issued, all of those things might be an important attribute.
What about when somebody is examining if it's better for a C Corp or an S Corp and it comes to limited liability protection?
Well, both offer limited liability protection as being a corporation, as do certain, LLCs, limited liability companies, and things like that. So it's that's an added benefit of the corporate structure in general. But then you want to weigh all of the different scenarios, and of course you want to look at other ways of managing that liability as well.
Okay. What about as far as for owner employees, if we were to look at any of the additional tax savings that may be offered or available through both options?
Yeah, arguably S corps because they're kind of designed for, smaller businesses, offer somewhat better options for owner employees.
Okay.
And a lot of that can come around some of the tax planning where, as long as you pay yourself a reasonable salary, you pay income taxes and employment taxes on that salary. But any additional profits can be paid out as a draw, as an owner's draw, which is not subject to employment taxes. So that can be an added benefit that really, mostly affects owner employees of smaller companies, right? Whereas the C Corp doesn't necessarily offer that type of flexibility. It's more designed for a segregation between the employees and the investors, right? So you may not have as much overlap in terms of significant ownership or control of the corporation and being an employee. Whereas with an S Corp, typically you're going to see, the key employees are also pretty significant owners of the corporation.
Yeah. So how does it impact then between the two, like the pass through benefits? Obviously, as laid out here, S corp a little bit smaller, limited who can hold stock, what type of stock, and so on. So how is there a differentiation between these two? Raising capital and so on.
Um, Yeah, I mean, in terms of raising capital for growth, typically the C corporation is beneficial, right? Because you have that division between the investors and the worker owners. And you want to have the most flexibility in terms of being able to raise capital to fund growth with the idea of really scaling the corporation. And of course, if a company gets really large, right, there's going to come a point where you may want to be able to go over 100 shareholders, right, as you're trying to attract capital. So that can be a real benefit. With an S corp, it's typically more often funded by kind of the few key owners slash employees and reinvested profits. And so, reinvesting those profits can come with some drawbacks. But basically, people paying the taxes and then reinvesting as they go. So yeah, you do want to have an idea of what the long-term goal is, although you're not set in stone either. There's lots of situations where companies will start as an S corp and then convert to a C corp. As maybe their goals change or their situation evolves. That can be quite complex. There can definitely be some pros and cons depending on the attributes of the corporation. But it's one of those conversations that you want to have periodically if your company is really scaling and you're running into some of these restrictions on the S corp maybe are no longer meeting the business needs.
Yeah. Anything else you want to lend to this section? Really, when it comes to the consideration between an S corp, a C corp, and examining what is right for your business situation?
Yeah, well, just as with anything, it takes a thorough review of the business goals and objectives, right? What the expectations are, and then of course the tax planning, right? Which in many cases is not just purely directed to the corporation, but also looking at okay, what's the tax planning with the corporation, and then how does that funnel out to the shareholders?
Yes, sir. All right. Well, let's jump into our next topic here, the growing cost of healthcare in retirement. According to Fidelity, a 65-year-old retiring in 2026 can expect to spend an average of $185,500 on healthcare during retirement, up 7.5% from last year. A retired couple can be expected to spend around $371,000. So, where are the nuts and bolts around this? What are we wanting folks to understand, especially for planning as, we continue to age, head towards retirement age or those entering retirement age and, the need for healthcare.
Yeah, I mean, having a plan to cover, healthcare expenses in retirement obviously is huge. It's probably one of the bigger liabilities, also one of the bigger unknowns, right, for a retiree, because, whenever you see these studies and they say on average, okay, well, what does average mean, right? I mean, obviously some people may be unfortunate and be very heavy users of the healthcare system in retirement because of
Yeah.
a number of health factors that could contribute. Others may be more fortunate and not have those high expenses. but you really don't know which you're going to be. So you want to try and have flexibility within your plan and be prepared for those expenses. So it is a challenge, and you have to look at the sources. I mean, they assume that people be collecting Medicare, right? Part A, Part B. A is free, but you do pay for Part B on a monthly basis, and potentially Part D, which is the prescription drug that also comes with an additional cost. Most people don't see that because it's typically deducted out of their Social Security benefits, but obviously it's still an expense. And then you have the real unknowns, which is, premiums for a supplemental Medicare supplemental plan. And then, of course, deductibles, co-insurance, co-pays, different prescription drug costs, and things like that, which can add up depending on the rate of healthcare usage. And it's also important to point out they are not including the cost of long-term care,
Mm.
which, if people need at their end of life because, maybe they're not getting around so well, or you also see cognitive problems like dementia, which can increase those costs significantly.
Yeah, well, and I know that it's laid out here in the personal financial review that nearly half of these costs come from the out of pocket, like you're saying, medical expenses. I mean, premiums, prescription drugs. There's other areas of it where it tends to be out of pocket expenses that really drive up that expense.
Yeah, I thought the real interesting part was, that 45% of this cost just comes from Medicare premiums, which, don't necessarily seem like a huge amount on a monthly basis, but obviously someone age 65, that lives a long time in retirement. And if you factor in continual cost of living increases to those premiums, right, that they will, continue to increase over time, it's really a significant portion of that 185,000 average number, which I thought was very interesting. And of course, the other concern is, a lot of people are not necessarily educated about, what Medicare covers. This Fidelity study found that 54% of pre-retirees incorrectly believe that Medicare covers all healthcare costs, when in fact, Medicare, it leaves quite a bit of potential out-of-pocket expenses. A lot of people don't realize Medicare is an 80-20 plan. They pay 80%, and that leaves 20% for the insured. Now, many people then add a private insurance policy, a supplement that covers that 20%, but still probably has some co-insurance or co-pays or things like that you may pay. There's also certain things that Medicare just doesn't cover that those supplemental plans will cover. So you really have to prepare for that additional cost of those supplemental plans because it's very important. And knowing that those plans will come with some expenses depending on the plan that you choose. If you take a lower cost plan, you may have more out of pocket. A higher cost plan may cover things and have a lower out of pocket. Really a decision based on your health situation and what you anticipate. Then there's, the other things such as dental, vision, hearing, and as we already mentioned, long-term care that are not covered. So people either need to be, setting aside some money to pay for those expenses, or potentially, having a dental or vision plan or something like that, which of course, maybe an added monthly expense.
Yeah. Well, with that said, with the planning ahead, how do health savings accounts maybe play a role for the soon-to-be retiree or those that are already in retirement?
Yeah, saving for, medical expenses. I mean, there's a number of ways to do it, right? You can accumulate in retirement accounts. You can have after-tax accounts that, may be able to fund it. But as far as tax planning goes, health savings accounts can be a great vehicle because you can contribute to them while you're working. And then anything that is not used can continue to be carried forward. In many cases, a portion can be invested so that there's growth. And then you can use those to pay those future medical expenses. They can, be used to pay Medicare premiums, used to pay the co-pays, things like that. So, and because the money goes in federally tax free and is not taxed if it's used for qualified medical expenses, you're getting that added benefit of the tax savings.
Yes, sir. Anything else you want to add before we jump to should you borrow from your 401k?
Well, just to reiterate, this is a very individual type planning situation, right? Anytime you see a study that says the average, you should always be a little bit skeptical. As we learned in statistics class, really the average can be distorted by a small percentage of the population spending very large amounts,
Right.
right? And then that gets averaged over everyone else and pushes the number up. Typically you would also want to see the median, right? The median being what does the middle person spend, which may actually be quite a bit less than the average to kind of plan, where your risks may be on that spectrum.
Yes, sir. All right, let's dive into should you borrow from your 401k? Of course, 401k loans allow participants to borrow up to the lesser of 50% of their vested account balance or $50,000 tax free for almost any purpose. But that doesn't necessarily mean it's the right choice to make. So, what are some of the ins and outs of borrowing from your 401k?
Yeah. So first, let's talk about exactly what that means, right? Let's say you have $80,000 in your 401k, right? The lesser of 50% would be $40,000 would be the max that you can borrow. If your 401k is 100,000 or more, then the 50,000, would be the cap, right? Because that's 50%. And typically with 401k loans, you repay those loans through a payroll deduction over a up to 5 year time period. And although and there's some exceptions to that. And the 401k, can provide quick access to cash without paying, credit card interest rates or personal loan interest rates, which are really high. You do pay yourself an interest rate, but that is going back into your plan, right? So you're basically paying yourself the interest, and you're putting the money back into your plan rather than paying back elsewhere. So that can be a positive, but in general, you want to avoid borrowing from your 401k because it is a retirement vehicle, so it should be thought of as a long-term benefit. And if people get in the habit of borrowing, it's reducing the amount that's invested. So they may be paying themselves an interest rate, but of course that's still coming out of their pocket, right? That's still their money that they're putting in rather than getting growth from the investments inside the plan, which obviously is a more attractive way to accumulate for retirement, to have investment returns rather than your own money funding it, which can be very difficult. It can put a strain on people's cash flow, right? Because now it's being deducted from their paycheck, and if it's if you take a loan on the 401k to cover a shortfall in living expenses, it's just going to reduce your cash flow that much more. So how are you going to dig out of that hole? And then the big concern is what happens if you leave your employer. Then you could be in a situation where that remaining balance may come due and you need to make arrangements to pay it. If you're not able to pay it back, then the loan amount is considered a distribution.
Oh.
And if you're under age 59 and a half, not only is that distribution going to be subject to income tax, but also early withdrawal penalties. So that's a situation where now you may not be able to get the money back into the plan in the future, and you're being penalized because you're paying taxes plus the penalty on those funds.
Yeah, is there any other options around your 401k as far as that goes? For taking a distribution?
Well, I think if there's really no other option, and the only other option is to, high interest borrowing such as credit cards or payday loans or even some personal loans, it may be the best option, right? Even though it should be avoided if possible, it's not a great option. It may be just the best option in that situation, and you have to weigh those pros and cons. There are some other, interesting scenarios where you can borrow to purchase a house and pay it out over a longer time period. So at least then the money's going into an asset that hopefully is, offsetting some living expenses and appreciating over time. Although again, you still have to weigh that versus other, potential borrowing options. So we kind of look at it as, borrowing should generally be the last resort. Ideally, you want to, build up an emergency fund so that if there's unexpected expenses, you can use that instead of borrowing against the 401k. But, at any given moment in time, it really comes down to just weighing all of the options and deciding what makes the most sense.
Yes, sir. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We start talking a little bit about the golf tournament that you're in. So let's talk about the Plan Solutions golf tournament. It is just around the corner. It feels like we were just hitting the course together, you, me, my son, like weeks ago, but it's almost here again.
Yeah. Summer's flying by, right? And we're usually one of the last tournaments and charity tournaments and the ones that I play in. But yeah, we want to let people know that the deadline to register is Monday, September 28th. So we still have a little while, but hopefully people will start getting things in. We're doing a really good job of getting giveaways and things that I think will really make the tournament fun. But we need to get some more momentum on signups. So, anyone who's considering, reach out to your friends, let us know, and let's make sure we get you registered. Date of the tournament is Friday, October 9th. It'll be at the Ranch Marietta Country Club again. They've done a great job for us. We're going to do the 1 p.m. shotgun start. So it'll be in the afternoon, and then we'll do the reception at 7:30. We're going to continue to do like we did last year, which I think went well. Instead of having kind of a sit down dinner reception where, it drags out, we'll do, some heavy appetizers, heavy hors d'oeuvres and things. And so, if people finish early and need to head out, they can do that. It's not hopefully it flows a little better like it did like it did last year.
Yeah, absolutely. Yeah, it was great. It was a wonderful way to, for those that stuck around, have some good camaraderie and do all the giveaways and everything else. It's just an absolute blast to participate in, and looking forward to participating again this year. Anything else you want to add, Chase, before we wrap up this edition of the Plan Solutions Incorporated podcast?
Appreciate everyone's support. It's been a busy summer. It's been a good summer for the market. So things have been going well, and hopefully we can keep that going into the fall.
Yes, sir. Absolutely. Well, we thank you for listening to the podcast. If it's your first time, hit that subscribe button on whatever platform you're on. If it's Apple Podcasts, please leave us a rating and a review. Those 5 stars do help. Or if you're on Spotify or whatever platform, if it has a ratings option or a review option, please do both. As well, you can go over to youtube.com/@plansolutions and watch along to a visual form on the podcast where the financial review appears on screen, the written form that we discuss here. And so, hey, subscribe there as well if that's the way you like to get your podcasts. And subscribe to that YouTube channel. Leave some comments if you have questions, or maybe there's some topics you would like us to explore here. And if you have yet to subscribe to the personal financial review, as I said, the written content that we discuss here, it's simple to do so. Send Katie an email, katie@plansolutions.com, and let her know you would like to subscribe today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.